Hello, thank you for taking time to listen to this update about Calgary Foundation's Primary Endowment Portfolio. I'm Lauren Frost, Director of Investments for Calgary Foundation. Along with the other members of the investment team, I'm responsible for managing the endowment. The purpose of this presentation is to update listeners on its strategy and target asset allocation, as well as third quarter performance figures and priorities for the coming year. Our team provides these updates semi-annually, so expect the next one to be posted around May or June with our fiscal year-end performance figures and updates. There have been no changes to the endowment's target asset mix since our presentation of first quarter performance. However, we're continuing to position the portfolio carefully within its targets to keep it strong and resilient. We continue to hold a higher allocation to cash and universe bonds as we take a thoughtful approach during market volatility and economic uncertainty. North American economies are facing slowing growth, high interest rates, uncertain trade policies, and cooling labor markets, so we're positioning the portfolio to be a bit more defensive leading into 2026. Also of note is the higher allocation to public market equities relative to their targets. Public equities have been performing well, so these mandates have been growing over the year with the market. Alternative investment allocations are trending down given a resurgence of distribution activities following a cooler period in prior years. We've recently added a new private equity secondary strategy reported on by Dan during the last update. We invested with a few of our private infrastructure managers, most recently I Squared Capital, and are conducting legal due diligence on a reinvestment with one of our senior secured direct lending managers. We anticipate the asset mix to rebalance more towards target as those alternative investment funds call capital, but have also established a buffer should there be greater volatility in public markets. The next slide shows a list of investment committee members and the managers that make up the endowment. We'd like to welcome longtime member Juliana Spiropoulos to her role as chair of the investment committee. And we thank Michael Meze for his leadership over the past few years. We are glad to see him continue on the committee as a member at large. Recently, Calgary Foundation reinvested with I Squared Capital's fourth flagship global infrastructure fund. The manager is continuing with its focus on mid-market infrastructure opportunities, seeking assets primarily in developed markets with long durations, inflation-linked cash flows, high barriers to entry, and limited sensitivity to pricing and demand volatility. The strategy also has strong industry and geographic diversification with a commitment to downside protection. While markets can be unpredictable, our diversified approach intends to protect and grow the endowment over time. This slide provides a snapshot of performance, which overall was 13% over the one-year period ending September 30th. This return is 69 basis points below the target benchmark, but outperforms the median Canadian balanced fund by 76 basis points. Over the 10-year, the portfolio has surpassed the median balance fund by 61 basis points and is in line with benchmark. The endowment has also achieved its 10-year real return objective. Over rolling 4-year periods, the endowment has outpaced the median Canadian balance fund over 3 of the past 5 periods. Absolute performance has been strong, and Calgary Foundation has met its real return objective. However, recently, relative performance has lagged. This relative underperformance primarily stems from 2 factors: the portfolio's allocation to alternative investments, which helps cushion it during public market swings, and the portfolio's focus on quality public companies meant for long-term stability. The endowment typically underperforms when public markets experience big rallies due to its alternative investment exposure, which is slower to respond to market shifts. The opposite is typically true in negative equity markets, where our private investments provide a cushion and often enhance relative performance. For example, private equity had a strong return of 10.2% over the one-year period, but underperformed its public market benchmark, the MSCI World Index plus 2%. Still, over 10 years, private equity has outperformed its historical benchmark by 5.7%, and we remain confident in its positioning over the long term given historical trends, falling interest rates, and improving exit conditions. Canadian equity and global equity have also been recent detractors to relative performance. Active large cap developed public market strategies have largely underperformed because of lesser allocations to AI-driven stocks and cyclical, lower quality industries held by their benchmark indices. Our active managers tend to perform well when preserving capital during economic downturns, but don't participate in short-term gains driven by cyclical stocks or concentrated positions. Our priorities focus on preparing the portfolio for long-term stability and success, regardless of short-term market movements. Our first priority is reinvesting with existing alternative investment managers that have performed well compared to expectations and their peers, and where the investment strategy still makes sense given market expectations at the time of renewal. The investment team also considers changes in a manager's operational stability, investment process, and legal terms of engagement when making reinvestment recommendations. As stated earlier, we have recently reinvested with a few infrastructure managers and are working on legal due diligence for a new commitment to one of our senior secured direct lending managers. Our second priority is reviewing the strategic asset allocation. Every 3 to 5 years, we conduct a formal asset mix study to ensure that the portfolio is well positioned to meet its rolling 10-year 6% real return objective. The most recent study was completed at the end of 2022. For context, given long-term market return expectations, risk, and asset class correlations, the study resulted in a few refinements. We increased the bond allocation given higher interest rates and infrastructure assets given their inflation hedging capabilities by reducing public equities. This new study might result in other refinements, but they would likely be at the margins given the portfolio is already well diversified. Once complete, recommendations from the study would need to be implemented and might result in a refresh of some manager relationships. We might also choose not to reinvest in some funds when strategies might be expected to underperform others over the longer term. Overall, we intend to move cautiously, especially when given growing economic uncertainty. There is no need to allocate to new investments quickly when the portfolio is already well diversified. Still, we understand that we must remain methodical and prudent, particularly when pacing our alternative investments. Please feel free to reach out to the Calgary Foundation team if you have any follow-up questions about the contents of this presentation, and thank you for your continued partnership.